Let me quickly address one of the questions that was asked in my last webinar, which is the funding hierarchy of a business. The question was, if my business is already making profit, should I approach an equity investor and bring them into my business? And the answer I gave was, if your business is already making profit, you need to think about two things. Is your company bankable? If the cost of getting debt financing loan is lower than the profit margin of your business or the profitability margin of your business, then why not go for it? Get that loan, get that debt financing. Because when you think about the funding hierarchy of businesses, debt, the cost of debt is lower than the cost of equity, right? So that is the first thing that should come to your mind, that okay, my business is already profitable, but I need more money to expand or to do a project. Then in terms of hierarchy of funding, I need to be navigating more towards debt financing. Why? Because I have enough profit to pay down my debt or to pay back my debt, including the interest on it. But if you think about equity, right? So equity funding is expensive. Think about equity investors as they are bearing the eventual risk of your business, because when your business goes into bankruptcy, you first pay the debt holders before you pay the equity holders. And sometimes if there is nothing to pay the equity holders, their risk is that they lose everything. Okay, so that's simple. That is why when they are investing money in your business, they are thinking about high expected return. If you do not think debt is there for you, or you think your business cannot support debt financing, that is when you approach equity. And that is how you think about the hierarchy of funding. And the second point I need to make here is that sometimes your business can still be profitable and you're thinking about equity, because it's just not about the cost of equity and cost of debt all the time as well. It can also be about what are the other strategic inputs that an equity investor is going to bring into my business. Because sometimes when you invite equity investors into your business, what happens is that they come with network, they come with introductions, they come with other strategic inputs. Because most of the time they have done this before, they've invested in similar business, so they can think about nexus between the problems you're currently having as a business, what other companies in the past have had, how they can solve that problem. So strategically, they can be a very big business push for your company, for your business, even though they also ask for more higher return than just getting in the bank for debt or raising bond. So that is what I wanted to think about in terms of hierarchy of funding. The first is, if your business is already making profit and you think you are bankable. Bankable means my business profit can support the cost of the debt I will get from the bank. Go for it. But if you think that I do not have profit, I cannot pay back my loan, I just need somebody to believe in my dreams, then this is the time when you are thinking about equity investor. But remember, equity investments, they are not cheap. I'll see you again in my next video. Take care. Bye.